Good afternoon. Welcome back to my course, Group Accounting. We did only a few things yesterday. The main thing was to go through the exercise to the case study and have a look at that. So I did not prepare a poll because I thought that is not possible based on what we've done yesterday. So I think the better day to resume what we did yesterday is to go through the case study Jamaica again. You know the facts on 107, so I will not read that out again. Then what we first did, we prepared the two separate financial statements for the two companies. That was the first thing. And then we prepared the consolidated statement of financial position for that group. So the reason why I'm doing this is I really want to make sure that you understand the principles of consolidation and not only be prepared for the exam, but also for the real life situations when you have to read consolidated financial statements, so that you better understand what is in there and how those people who made the financial statements, the consolidations, how they got to the numbers. So the first thing is that we look at the separate two financial statements that is after the acquisition. So here we have the single financial statement of the parent, and it shows an investment of 450, which is the 80% of the equity that is shown in the subsidiary Kingston. And while we know these two numbers are not the same, because probably Jamaica has paid a premium that will result in goodwill, and obviously they have not bought all the shares of that company. So this is why in most of the cases in practice, these two numbers do not match. All right, so we have the local financial statements here. We call them single financial statements number 1. And then we have to prepare the single financial statements number 2 out of these two single financial statements number 1. So the first thing we would do is we would take the book values of the parent, but in this case, the book values are already according to the accounting manual of the group. So in that case, we will not change the parents' financial statements. If they would show a different currency, or if they would not follow in all material respects the group instructions, well, then of course we have to change those numbers. But in this simplified example, they are already in the group account policies. So in the group policies, they are following the group policies. Therefore, it is the same. We do not change them. But you have to understand this column represents the book values because on the date of acquisition, we will only change the numbers of the subsidiary, because IFRS 3 tells us that we have to value those at the fair value at the acquisition date. So that is why we have book values in the parents' books. And here we also have book values, but we will transform them into fair values. And we had some facts and circumstances given for this example, for this case study. And it said there were hidden reserves in tangibles of 20. There were hidden reserves in inventory of 10. So we have to account for the difference between fair values and book values just by increasing those numbers. So we debited tangibles by 20, debited inventory by 10. And well, we acquired the company, or Jamaica acquired Kingston at the acquisition date, and those were the fair values. So obviously, the equity must have been higher before that acquisition date. So we will just credit the retained earnings, that means the profits before the acquisition, with that number. So that is why we would increase equity by 30. So by crediting the retained earnings to reflect the increase of the fair value compared to the book values at acquisition date. All right, so I think that is clear. We now have in this last column of Kingston, we see the fair values of the subsidiary, but it's still a single financial statement. It has not yet, it has nothing to do with the consolidated financial statements, because we just worked on the single financial statements of Kingston. Now we will look at the consolidation table. No, before we do that, we have to calculate all the numbers, and that is done by following the 5 big workings, how Glendon would term that. So we first look at the group structure. Well, this one is, of course, quite easy. We considered that the parent bought 80% of Kingston. So we have other shareholders that are not part of the group. They are called minorities or non-controlling interests, because those interests, those shares, have no control about the Kingston. The control is only exercised by Jamaica because they have 80%. And in a shareholder meeting, they can overrule the non-controlling interests. All right, so that was the easiest part. Then we would go to the net assets of the subsidiary. And well, there are 3 possible ways how to calculate the net assets of that subsidiary. It could just be you can calculate, take all the assets and then deduct all the liabilities, but at fair value. So you should take the 530 and not, you should take the 530. This is the number of the assets at fair value. I see in the exam that probably some of you would take 500, but that is not the number at fair value. So when we look at goodwill, when we look at NCI, we want to know what the fair value is, and therefore we have to take the assets at their fair values. Same thing with liabilities. So net assets are assets minus liability, which is 330. Or you just should take the share capital plus the reserves, which is also 330. Or you just, if you have that number, you just take net assets, which is equity. So there are 3 ways to calculate. The first is take all the assets, 530, then minus the 200 non-current and current liabilities, then you have 330. Or you take ordinary share capital plus retained earnings, you get 330, or you just take equity, which is also net assets. The 3 ways are the same. You don't have to show that to me in the exam, just take the correct number and then you're fine. So in this case, at acquisition date, which is of course at year end, net assets are 330. Well, at year end, of course, the net assets are the same in this case. because the acquisition took place at the last day in the year. But it could be different. So if, for instance, the company was bought in the middle of the year, so like the 1st of July, then of course you have half a year as the so-called post-acquisition period. And during that post-acquisition period, the company would produce profits. And in the end, you have to allocate those post-acquisition profits to the retained earnings of the parent. But we will come to that, as you know. Okay, then we looked into the non-controlling interest. Well, if we have the fair value of the net assets, which is 330 in this case, well, we just take the share of the non-controlling interests, which is 20%, and multiply those net assets with 20%, and you get the correct result of 66. So the value at fair value, the fair value of the non-controlling shares are 66,000. Whereas you could, yes, okay, 66. Now we are in a position to calculate the goodwill. So what do we want to have? Well, we want to compare 100% of what the companies paid for the net assets, or what they own in terms of fair assets, of fair value of the asset, of the net assets, when it comes to the non-controlling interests. So we would, on the one side, put 100% of the shareholders, the value of the shareholders, and then compare 100% of the net assets for these. So we would you would take the cost of the parent's investment, that is the purchase price for the 80%, that was 450. Then you would take the fair value of the other shares, which is 66. So 450 plus 66. So you then have the value of all the shareholders. So what they paid, or what would be a fair share in the assets that they own. So that is 100% of the shares. And now you can deduct 100% of the assets to find out what is the premium paid by Jamaica. And when you do the math here, then you have a positive difference between what the net value, the fair value is for the shares, compared with the net assets that they have when you look at the assets in terms of fair values. So they obviously paid more than net assets, and the difference is 186. So we call a positive difference, we call that a goodwill. So goodwill is 186. Well, then we're able to calculate the retained earnings of the group. Well, basically the retained earnings relate to the shareholders, because we have calculated the NCI in a different account. So the parent, the retained earnings relate to the parent only, to the shareholders of the parent only. So we start from the parent's retained earnings, and well, we will then add any benefit that is related to the shareholder. We would add that to the retained earnings, to the post-acquisition, as the post-acquisition profits. We would allocate to the retained earnings of the parent, and that is then called the retained earnings of the group. So in this case, Jamaica acquired Kingston on the last day in the year, so therefore there is no post-acquisition period, and we do not have post-acquisition profits. But in the exam, or in reality, you will have post-acquisition periods, so you have to account for these. All right, so I think that is pretty much the picture of the 5 workings. So we have all the numbers, and we can put these into the consolidation table. Well, here's our consolidation table. We first would enter the single financial statements number 2. So following the group accounting policies. So we just take the book values of the parent and put those in here. So there is no change to the single financial statement number 1, because they obviously set up their accounts following the group instructions. Now, Kingston had to be revalued at fair value. So we will put in the fair values for the subsidiary in this column. So you see the tangibles include the hidden reserves now. So the hidden reserves are no longer hidden. They are clearly shown on the balance sheet. Same thing with the hidden reserves in inventory. They have been realized and put into the evaluation of inventory. And what else changed? Well, equity increased from 300, which was the book value, to 330, which includes now the realized hidden reserves, intangibles, and inventory of 30. So that's pretty much what we did. And then we add all the all the lines in these 2 columns. If we had 50 companies in a group, well, we would have 50 of those columns here, and then the list would be a little bit longer, but the principle is the same. So we just stick to this simplified example to be able to understand the principle. So we add all the parent, well, the one parent, we will add the one parent and all the subsidiaries, which is in this case only 1, to a subtotal. So we have that subtotal. Please check that the total of assets is the same as the total of all liabilities and equity. So in this case, this is okay. And well, when we look at this subtotal now, we can see, well, tangibles, that is okay, because you have 200 from the parent, 120 from Kingston, the subsidiary. So in total, that's 320. So that's fine. But when we look at investments, well, that does not feel right, because the group does not have an investment in Kingston, because Kingston is now included in the group. All the assets and all the liabilities were taken into these subtotals. So Kingston is included in this 320. Kingston is included in the inventory with 210. So 210 of these 250 relate to Kingston, and only 40 to the parent Jamaica. So that is why we have now twice, Kingston is twice in the group, and that is not correct. So we have to eliminate the investment which we have, whose assets we have allocated to the group. We have to eliminate that. And to do that, we will just enter a credit of 450, so no investment will be shown in the consolidated financial statements. Well, what else do? we know that we have to eliminate 100% of the ordinary share capital and 100% of the retained earnings. So we will enter a debit of 200 and a debit of 130 here to eliminate the ordinary share capital and the retained earnings. So in the end, you will see only the ordinary share capital of the parent, which is 100, and the retained earnings of the parent. Okay, so what else did we do? So we have a difference between 450, getting rid of the investment, and the 200 and 130, getting rid of ordinary share capital. Well, we take the goodwill and debit in these consolidation entries, we debit the goodwill with 186. So in the end, we will show 186. And there is still a difference of 66 now when you have made these 4 consolidation entries, and that is the non-controlling interest. We have calculated that to be 66. So we will input that number here. And in the end, the group accounts will show a non-controlling interest that is the value of all net assets, which is related to the 20% non-controlling interest in Kingston. So when looking at the group, you know there are several shareholders which are not owning the group. So they are called outsiders, they are called minorities, they are called non-controlling interests in this group. Yeah, and when you make the math here, you add up all the assets, including goodwill. Goodwill is an intangible asset, which is shown in the group. The sum of the assets will be 1,116. And when you do the math for the liability and equity side, you come up with 1,116. So in the end, there is no investment shown in the CFS because the investment is an asset that relates to the single financial statement of the parent. It is not a group asset, therefore we have eliminated the investment. We will show goodwill, which is an asset of the group financial statements. It is not an asset of the single financial statements. So in the exam and also later on in the practice, don't put goodwill on the single financial statement. It belongs to the consolidated financial statements only. All right, and then in the end, please check that only share capital of the parent is shown in the consolidated financial statements. Otherwise, you have made a mistake. Well, the retained earnings may be different because currency translations and sometimes profits that go to retained earnings or go to the profit and loss account of the current period will also be shown in retained earnings, and therefore this number is in most of the cases different in the practice. Yes, and you show non-controlling interest in the CFS to reflect the share of the minority or non-controlling interest shareholders. Okay, that was pretty much it. I saw that the video did not include the poll, so I'm very sorry about that. I think when I pressed my computer's button by mistake, Zoom did not finish that video. So it starts after I have resumed my computer. What I did, so that you have no problem with that, I marked the poll with the statements that, from my perspectives, are the correct statements. So you can look at the Word document I have uploaded to the Ilias system yesterday, and you can have a look at those and at that poll. All right, so far so good. Do you have questions of what we have said now? Well, if not, then we can go into the next chapter, which is about negative goodwill. So we just calculated a goodwill, which is a positive asset. But what if the purchase price is lower than the fair share in net assets? Is that a bad will, or is it a lucky buy? And we will find that out. All right. So in this case, we have a purchase price of 250. We have identified assets at fair value. So that is 700. We have liabilities of the subsidiary, which is 300. That's an assumed liability at fair value. And the share of the NCIs, so when you value the net assets at fair value with the share of the non-controlling interest, that is 60 in this case. So when you make the math, you assume 350, 410 minus 700 is 90. Is that right? So 250 minus 700 plus 300 equals 150. So minus 150 plus 60 is a negative difference of 90. So I just did what the IFRS requires from an accountant. If negative, check again. Okay, so I checked again, and well, yes, the difference is negative. I will check the purchase price again. I will check all the identified assets. So maybe I forgot one, maybe a patent that was not sitting on the balance sheet. Now it has to be put on the balance sheet during the acquisition. So all the items that the acquirer will acquire have to be put on the balance sheet, and they have to be valued at fair value. So, okay, in the case, we checked again, and we checked all the substance of those items. Then we have now three possibilities. So why is it? Why is it that this difference is negative? So in normal life, you would understand, or you would think that if there is a fair value to a company, then why the shareholders do not want to have that amount of money? Why do they accept a lower price? So that is not normal. And well, there could be three possibilities. Well, maybe there are future losses. So in that case, we have a minus 90. And that is a capital reserve in the consolidated financial statements. So if future losses exist, then of course the acquirer knows that there will be future losses, so the equity will be used by that, well, the acquirer does not want to pay the future losses that are already implemented in the financial planning and that will unavoidably be there in the future. So probably what the investor would do is deduct the 90 from the purchase price. So instead of paying 340, which is 250 plus 90, because if we would increase the purchase price to 300 and what is it, 340, then this whole thing would be zero, and what the shareholders will pay is just the fair share in the net assets, right? So what you would do is you would set up a capital reserve, and in the future, when the future losses will be there, then of course the capital reserves can be used to cover the losses that will be there in the future. Question, why would you not set up a provision for those future losses? Can you put that answer in chat for me? The question is, I just said if there are future losses, we would set up a capital reserve. So why wouldn't we set up a provision for future losses? From an accountant point of view, that's the same thing. We would put a credit in the provisions, and if the losses are there, we would release the provision, and that would cover the cost of the future losses. So why would we not set up a capital reserve for, a provision for future losses? Oh, that's a good question. I'm thinking about that to put it in the exam. So the other idea would be to, if you have future losses, you would just, and you now have a negative difference, you would put that in as a lucky buy, or as a gain, which you have because of the of purchasing net assets that are you pay less for them, so you have a gain. And well, in this period, you will show a gain from the acquisition, and in future periods, when the losses are materializing, then you would have a loss. So two lies is one truth. Yeah, so the gain in this year is too high, and the losses in the future are too high. So both is not correct. So you would have two lies, which would be consolidated into one correctness, in one correct answer. So can you give me an idea why you would not put in a provision for future losses? No idea? Oh, come on. There must be one of you that must be so bright to answer that question. Aha, we have one. Because there is no obligation. Wow. I like that one. Yes, that's true. There is no obligation. if you would close the company tomorrow, then probably these losses will not materialize, right? So you have no obligation, and that is exactly the right answer. I think provision is appropriate for an estimated or calculated expense. Yes. So if there are payments in future which are a result of present operations, so then you would put a provision in the financial statements. So if you have a big hole that you digged and you took rare earth out of it, so you have the obligation to cover that hole in the future again. So that is why you would set up a provision, because the expenses are related to this period where you dig the hole and got all the rare earth out of it and sold it. And therefore the expenses are related to previous periods where you set up the provision. And in the case where you have future losses, you will not have that obligation. So it is not related to to the previous periods. The future losses are related to future periods, and you should book the losses in that period where they are coming up. All right, so that was a very good answer. There is no obligation at the end of the reporting period. Okay. Maybe because these future losses can be avoided by future business. Yes, that's right. It's not clear that these losses will materialize. And if you have a good idea to prevent these, then of course you will not have the future losses because of future gains. Yes. Okay, so they can be avoided, and therefore we will not set up a provision. But of course, we cannot put it in the income statement right away if we know that there will be future losses. We cannot record that minus 90 as a gain because, well, we have a gain then now, and in the future we have losses. And that is what I just described as two lies. So one higher profit, and in another period you have losses. So these two lies would then could be seen with each other. So two lies do not give one truth. So we're not allowed to do that. Okay. All right, so yeah, I think that was a very interesting discussion, and I'm glad that at least some of you got that right. And I think that there might be some of you who thought that, but did not dare to show that in public. So I understand that. So I think you're on a good way. If you did not understand the discussion, please go back maybe to the video, and then you can maybe understand that one. So we have three possibilities if this difference is negative. We first check whether there are future losses, then set up a capital reserve. The second thing would be if there are future expenses that were not booked by the investee. So I think in the PACC course, we had the example that the investee was near bankruptcy. So they thought about a restructuring, but did not inform the workers by that time, because they hoped that when they get an investor, they get fresh money and they will not have to declare bankruptcy. And in that situation, they are not allowed under IFRS to set up a provision for the restructuring, because only when people know that they will be affected by that closing ideas of the management, the provision can be set up. But I mean, when in this situation, the company is sold, then of course the investor will look into the financial planning, and probably they are talking about closing the company and doing a restructuring plan. So they would say, well, what does it cost? And they will deduct that cost, which is an expense then, of course, from the purchase price. And maybe that is the reason why there is a negative difference. And if those provisions have to be set up, well, they have to be set up in the consolidated financial statements. So we will show those 90 as a provision. Well, and then, well, if there are no future losses and there are no restructuring needs, well, maybe the shareholders just wanted to get rid of it at any price, and the best price they could get is losing 90 bucks on the whole transaction. So from the side of the buyer, of course, that is a lucky situation. So in that case, the investor can record a lucky buy in the consolidated financial statements. So I think that is rather complicated, and therefore I think we should do that in using the following slides. So please go to the breakout rooms, and FAM, I will check whether you go there also. So please go to the breakout rooms and use, I think the form is on 118. Yes, okay, so the forms are there. So please use the form and answer this, this case study. So I will put you in the breakout rooms now. All right, so welcome back to the course. We're all back from the lucky case study, and we will look now at the 5 workings. We determined the group structure. Lucky bought 75% of buy. So we have a non-controlling interest of 25%. When we look at the net assets of the subsidiary, of course, we have to take the fair values. So we have to look at the single financial statement number 2, not at single financial statements number 1, because those represent only the book values. So we have to go to the single financial statements number 2. There we have the net assets of 290. So assets including hidden reserves of 50, 650 minus all the liabilities valued at 360. So we have net assets of 290. At year end, they are the same because I think they bought it at the last day in the year. The non-controlling interest is just the 25% of net assets. So that's the value that the shareholders represent that are not part of the group. And therefore we call them non-controlling interests or minorities. Some of you said 72.5. So when in the exam you make a different rounding than I do, I don't consider that as an error. So as long as it is materially right, I will accept your answer. Calculate any good or bad will. Well, negative difference is 67. We don't know whether it is a lucky buy yet. So I would just would tend to call this a negative difference of 67. Well, then the retained earnings, they start with the parent earnings, and you would increase that number by any share of what gets to the parent. So if it is a lucky buy, then of course this 67 would go to the retained earnings of the group. Therefore, the number is 317. All right, so we now put those data into the consolidation table. Well, first, well, maybe I should put that table in front of the big workings, because this was the column you had to look for when you calculated the net assets. So we did that already. And then we have the three possibilities. We have three blank forms. The first situation is we look at the financial planning of buy, and then we find out, oops, they will make losses in the future. And those losses are around 67. So what do we do with this credit now? Well, if it's a future loss, then we would have to strengthen our capital, our equity, and we would put in a capital reserve in the consolidated financial statements of 67, and that will increase equity to 417. I'm sorry, this line should go before equity because it's included in the sum. So I'm sorry I would change that for the next cohort. All right, so that was A. What about B? Well, if there are future expenses, then we have to book these expenses in the consolidated financial statements. Thus, the current liabilities will be increased to 727. So future expenses not recorded by the subsidiary are recorded as a provision. And if there is no loss in the future, when we look at the financial planning, when there is no restructuring, when there are no future expenses that are not booked by the investee, well, then the buyer is lucky. And in that case, that is a day one gain, which normally does not happen in accounting, but that is one rare case where it does. Then you will have to record a gain that increases the income for the period. And of course, as we have a double entry booking system, the retained earnings will go up by that amount. So in the end, you have retained earnings of 317. Oops, but now I see that non-controlling interest, yeah, should also be within that. So never mind. Okay, and well, there we are. What do we take away from this small exercise? Well, a positive goodwill is a premium accounted for as a group intangible assets, which is subject to an annual impairment review. We call that goodwill. If you have a negative difference arising on consolidation, that may be a discount and accounted for as a group profit, so lucky buy after double checking. Unless there are no future losses, then in that case you book a capital reserve. And if you have future expenses not accounted for by the seller, well, in that case, you would book a provision. All right, I think that's it. There is a question in chat. In the second case, I can credit the provision. What do you mean by second case? Which slide are you referring to? Can you just put in the number of the slide? In the second case. So Tran Minh Duc, that was your question. Slide 125, okay. So in the second case, that is second case, yes. Well, are you talking about the 100, if you put in 67.5, well, then you would have 727.5. Is that the question you have? So in the second case, can I credit the provision by 66? Yeah, that's what we did. So I don't understand your question, I'm sorry. I mean, from another row name provision. Ah, yes, of course. You can put in as many rows as you like. That is your creative possibility of setting up financial statements. Yes, you could do that. But in the end, it would not change the total of the liabilities, would it? Yes, okay. Yes, okay. That's fine. Now it's 5 minutes after 3. We will have a small break of 15 minutes. So I would like to see you again at 10:20. Okay, so bye-bye for now.